Welcome to episode 64 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special return guest on to talk with us about all things coal, and we'll get into copper and rare earths and some other different topics as well while we're at it. And I think it'll be a interesting conversation on the state of several different markets, but I'm really excited to have him back. So Matt, thanks for coming back.
Hey man, happy to be here. Thanks for having me on again. I love talking about this stuff pretty much anytime. So and especially happy to do so with your audience. So man, let's get into it. What's on your mind?
Yeah, so I figured it would be an interesting time to have you back because all the coal stocks have had a nice little rally off the April puke Liberation Day, whatever you want to call it. But it's been, I think, a lot of short covering, and you see that in other sectors that have been out of favor. But I think it is a sector that's been very cheap for a long time. But for some of the stuff that you've been saying, it sounds like you think we might have to wait a little bit longer to see like the real buying opportunity, maybe later this year or somewhere around there. But maybe we can get into like your high level view of met coal versus thermal and kind of see where that takes us.
Yeah, well, I mean, first off, let me just say that, the worst is behind us on both sides. The met coal price collapse from $600 down to here in the high 100 levels happened because the China recession was pulled forward from 2025 into 2024. 10 years ago when I was at Wood Mackenzie, we projected China peak steel at 2025. That actually happened last year. Production's down about 9%, I think, since then. So while the work that I did 10 years ago was pretty close, it still happened at a time where, we thought they would still probably push, steel production pretty hard into last year. And instead they produced more and exported it, which made it pretty difficult for other countries to catch up with. On the thermal coal side, thermal coal goes where natural gas allows it. So, and similarly, met coal goes where steel prices allow it. So, when there's an abundance of one commodity in the market, those betas are going to be attached pretty closely, which we can show you here in a second pretty easily. So, on both of those, I think, the fall is going to be probably pretty tough. I think October and November, we're going to probably try to retest lows, but coal, both thermal and met coal kind of run in this 5-year cycle. So we're about ready to start a new one. And I think that new one probably begins in mid 2026, to be honest. But it could happen this fall. We could see just the trough this fall, and everything from then on is going to be higher highs and higher lows. But we'll make that determination. In the meantime, everything's tradable, and everything has been kind of gloriously range bound for a really long time. So if you're a degen trader, it's possible to have a pretty good time trading coal stocks, even though the market's not where it was a couple of years ago.
Well, they can be pretty volatile where they have some big moves in both directions. And it's always interesting to see, like I have all the tickers kind of the whole sector on the watch list. It's like, there's, I'm sure, some news article that is sending AMR up 10% or 12% in a day and stuff like that. And you kind of see the volatility that is pretty interesting to watch, but I think it'll be a while before you have like the fundamental backdrop for maybe holding these things for maybe 3 to 5 years. But I think one of the high level things that I think is interesting, at least for me, is kind of the thoughts on what you were saying about the thermal coal going where natural gas allows it and how that ties into LNG and some of these other things. I had Wilson from HFI Research on the other day, and we were talking about natural gas and the LNG demand story. How do you think that long-term kind of plays out and has an impact on the thermal market?
Well, I mean, I'm a U.S. based analyst, so let me approach this from the U.S.'s perspective. The more that we export, the less is going to be available domestically for our own, data center build out, which, heretofore has moved at the speed of capital, which is to say pretty quickly. The hyperscalers can make plans to build data centers faster than we can, build power plants to accommodate them. So we're, sometime in 2026, we're going to run up against the capacity limitations of our domestic baseload power generation capability. If supply and demand, whether we like it or not, always meet. So, either we have to restart coal plants that have been, recently retired. We're going to have to do that. Or we build some new gas plants, or we eliminate the red tape on nuclear, or else, the AI boom is going to have to physically slow. It'll be forced to. Otherwise we're going to get rolling blackouts in regions that can't, the people won't stand for. So, I think we're coming up on a physical reckoning for that in the U.S. itself. Now, abroad, Europe is building out data centers in the same sort of way. China is building out data centers in the same sort of way, but like China has a lot of domestic thermal coal capacity that they can utilize, right? Part of the reason that they have consciously transferred their vehicle fleet from internal combustion engines to electric vehicles is because they have a lot of coal power at the ready. They have a lot of hydro at the ready. They have the capability to plan for that. And, although carbon emissions from power generation are going to go up, the carbon emissions from the vehicle fleet is going to go down. So to some extent, both of those things are going to offset. So it's a complicated picture. But, I kind of think of, the international thermal coal market, for better or for worse, in two different buckets. The Atlantic Basin is going to do whatever TTF does, which is partially dependent on whether or not Europe, post-Ukraine Russia war, will accept Russian gas again. And if they do, then, obviously the capacity is limited without Nord Stream 2. And we're going to be able to ship LNG over there as well. Separately from that, in the Pacific Basin, then we have the Japan Korea marker, right? The JKM. And I don't think that supply demand dynamic is going to change materially. So I think kind of thermal coal prices are here for a little while, until either China begins to ramp up its own AI capacity in the Pacific Basin, or we start to hit a wall, or Europe starts to hit a wall, and then I think you'll start to see attitudes around coal-fired generation, reverse again, similar to what they did, in the energy crisis times of 2021 and 2022. Does that make sense?
Yeah. As far as like you laid out a pretty interesting kind of set of barriers, whether it's nuclear or gas or whatever it is for AI build out in data centers. What's your kind of view on how long that might take to resolve itself, and which domino you think is the most likely to, or I guess which barrier is most likely to get removed? Do you think it's nuclear? Do you think the natural gas side, or do you think the coal plants, because there are a lot of existing ones that could just be turned back on? What's your kind of view on which one is most likely?
I think unretiring coal plants is easiest, and I think there would be support for that in this administration. The Department of Energy just tweeted out yesterday, a picture of coal with, she is saying like she is the moment or something like that. And
they need to hire a new social media intern for the Department of Energy.
It's pretty gross. Like, I'm fine with, I retweeted it, and I said, I'm fine with romanticizing coal, but it's not a girl, it's a rock. And if you want to romanticize something, romanticize the people who risked their lives to go down underground and go get it. But like, happy to have support. Just like, let's not make this some sort of marketing campaign. You know what I mean? let's just go mine some coal and let's restart some plants and let's do the job,
Yeah,
Um,
actually get to work instead of talking about it.
yeah, like I have very little patience for that sort of those sorts of shenanigans. But like, I think broadly speaking, my side of the aisle, as a card carrying liberal, is resistant to it until it's necessary. And what will make them realize that it's necessary are, when we actually do run up against capacity and we have, rolling blackouts or brownouts or the danger thereof. My friend Bill Rainey, who used to be the president of the West Virginia Coal Association, always used to tell me, well, if you have a mining accident, you get a mining law. Well, guess what? If you want an energy law, then you need to have an energy accident, and that is, sadly, for better or for worse, an axiom that is true under all circumstances. So I think that's probably what it's going to take to get kind of unanimous support for, like, okay, well, I guess we got to restart all these plants. I mean, Microsoft already restarted 3 Mile Island. So, the public's will is changing, and it's changing because all these, Mag 7 companies that are, bringing jobs to these areas want to do things that people weren't previously interested in. So that's why I think that we're approaching kind of critical mass on it. Just because there's only so much baseload capacity to go around, and at the pace we're building out data centers just in the DC area, I mean, is so fast that we're going to run up against grid capacity pretty soon. So that's kind of that's an overarching concern, but I think it will be positive for domestic coal prices in the short run.
As far as metallurgical coal, getting into some of the stuff that's going on there, I still look at that commodity as kind of the ignored, one of the most ignored things, maybe outside of like platinum or something. But
Yeah.
I look at it and I see a bunch of stocks where it's like, yeah, you can pencil out some pretty good returns over like the full course of a cycle, but
Mm-hmm.
they're just kind of underfollowed and ignored. But I think that'd be a good way to get into some of the differences between the U.S. names and Australian names, and
Sure.
kind of see what your
Well,
view is on the
let
met coal
me
markets.
yeah let me share a screen because this is easier to show than to tell. Um, uh, so let me do this one. All right. Can you see that at all?
There we go.
All right. Yeah. So this is, the black line is coking coal, and the red line is Shanghai rebar, steel rebar futures. So if I zoom out to, to 5-year plan, you can see how closely they track. Like the first thing that happened and why we had a run up in coking coal prices to begin with is because, Shanghai rebar went to the moon in 2021, and coking coal follows that on a lag. Now, since then, they've almost been in lockstep. And when I zoom into the 1 year, you can see where Chinese steel prices have had a really rough time domestically, and that has limited the ability of coking coal to rise up. But here again, we have this little spike here, which is largely, I think, driven by hot air coming from the Chinese Communist Party. But at the very least, that move up in price has allowed met coal to kind of rebound to where this range is where I think we're going to be for most of the time. There's only 2% of met coal is traded on the global spot market, and it's highly manipulated by end users. But when buyers are in the market, kind of magically the price moves into this like 180 to, let's call it, a maximum 200 sort of level. So, we're at 187.50 today. I think that's kind of par for the course. Um, so, with that said, um, China's cycle is dependent upon um, their willingness to address overcapacity issues during the next 5-year plan, which will come out in October. We're hearing some rumblings right now that steel capacity will be part of that being addressed. It could possibly be addressed in the U.S.-China trade deal, which will happen at some point in time. We just don't know exactly when. Um, and also everybody has to realize that the difference in the global seaborne market is just that China usually exports about 50 or 60 million tons of steel, and right now they're exporting about 110 million tons. So it's only about 50 million tons difference, and that is out of 1 billion tons that they produce. So the delta for them to adjust the market is incredibly small, and can definitely be addressed pretty easily, either by shuttering smaller, higher cost capacity operations that are far inland, or a number of different other ways. So this is not a big ask. And then when that does happen, and I do believe it's going to happen, it happened in 2014, 2015 as well. Either the trade cases that have been brought against China are going to win out, or alternately, they're going to adjust their capacity themselves. One of the two. That allows India, which is going to grow at not the same rate that China did during the early 2000s, but it'll grow at a similar rate. And that's what will carry both steel and met coal through the end of the decade. And that new cycle is going to start. A lot of those plants in India have already been built, but they're not yet running at high capacity utilizations because there's been so much Chinese steel available in the market. Period. Stop. So once export slows, then India is able to rise again. And there are two other things that I think we need to also think about. Number one is the Ukraine war is going to end at some point. When the Ukraine war ends, there will be demand for steel to rebuild Ukrainian infrastructure, whether that is on the Russian side of Ukraine or whether that is on the Ukraine side of Ukraine. And although most people have that in their models, most forecasters do, like the timing of it is uncertain. And so, most people just kind of have it penciled in for 2030. If that happens next year or this year, then, there will be, a tug on demand that, is heretofore unexpected. And the second part of that equation is Europe. Europe has been importing Chinese steel as well. They're not importing Russian PCI, so they're having to make coke. So they've kind of reduced their capacity. They're not making as many electric vehicles as they said they would. Volkswagen and Porsche have both been kind of drags on their equities. I don't know if you follow those, but there are structural problems in Europe from a manufacturing standpoint that will at some point get addressed and will reverse. And I think the green steel narrative there has died a death. I don't think the Germans are going to go through with their project, and I'm almost certain that the French won't either. So, the hydrogen economics just aren't there yet, and the likelihood of that being, a threat by the end of the decade, I think, is zero. So yeah, I think we have one more really good met coal cycle in us that'll probably take us sometime through, let's say 2027 to 2032. And so we're not quite there yet, but we're going to trough and we're going to reverse here soon enough.
Yeah, I think to add to what you're saying about Ukraine, I'd have a hard time seeing how it's not resolved. However, it does happen before 2030. I just don't see it lasting that long. However, it does finish up. And so, like you said, I think some of these things with the European economy will, I think, eventually get addressed. But I'm kind of a like big time like secular bear on most things Europe anyway. But that's I guess a separate discussion. But
my largest holding is Rheinmetall, the German defense contractor, and that
thing's been off like a rocket for.
Hey, if we're going to force the continent to rearm themselves, I just do whatever the policy says, and you don't really question it. But also, by the same token, we can't predict it either. We just have to react to it. And that's it's frustrating for forecasters like myself, but actually as investors, it makes it a lot more simple. If you know something for certain, just do that thing and kind of leave it alone.
Yeah, I think I was thinking we'd get into some individual names, but that's maybe a better segue into some of the stuff that's been going on with copper and the recent MP Materials deal.
Sure.
That's going on there, because I think the thing that I find interesting is you have people talking about free markets and all these different things, and then you see what happens when real life meets idealism and some of these things. So it's I think there'll be something we see more of for certain specific cases, but I'm not sure if that feeds directly into the coal market specifically, but I think there are some coal names that are impacted by rare earths and some of this other stuff. So maybe we can get into that.
Certainly, yeah. One just reported yesterday, as a matter of fact. But yeah, the MP Materials deal is going to happen. We're going to build the magnet facility here in the United States. We're going to build a processing facility here in the United States, and even Ramaco Resources. Although I question the prices that were used in that flu war analysis that came out. I'm almost positive, not quite 100% positive, but pretty sure that there's going to be government money available to build that processing facility as well. I don't think the grades there are anywhere near what MP has, for instance. So it's hard to get super excited about it, but it will be a coal mine, and the coal mine itself will make money. And as long as the government is the one paying for the rare earths processing facility, then kind of who cares, about the capex cost for that. It's not going to come out of met coal. There's also a company called Recycle, REE Cycle, that has been doing a private capital raise that's going to recycle magnets. And, kind of in the same vein of, I don't know if you're familiar with Hyperion X, the titanium company, just built a facility in South Boston, Virginia, down in Halifax County, I think. They're reprocessing titanium scrap, which the U.S. is incredibly long. We've gotten most of our titanium from Russia and China over the past, 50 years or whatever of the 70 years of the aerospace industry, and something like 85% of titanium winds up as scrap. And if it gets oxidized, reoxidized to TiO2, then you can't remelt it. So, we just have stockpiles of this shit. We're pardon my French, but the U.S. is very, very long titanium scrap. And similarly, we are very, very long magnet scrap, but we have no recycling facility just yet. And Recycle will do that. So I think the combination of MP Materials, which is, it has very high concentrations of light rare earths that aren't particularly valuable, but they do have neodymium, they do have dysprosium. Those concentrations are okay. That's not an insignificant part of their revenue stream. But with Recycle, we'll also get the heavier rare earths. We'll get the ytterbium. We'll get the other elements escaping me right now. But
all the other things that are impossible to pronounce, basically.
Yttrium and terbium. Yeah, I have a chemistry degree. I should know this right off the top of my head, but the combination of those two things plus a magnet manufacturing facility, plus whatever Ramaco can do, and we'll probably over the next few years find a few other projects that the government will throw money at. I don't know if all of that is a great investment, but I do think there will be, a clear shift in our ability to service our own demand for magnets. So, whether that's 20% of our demand or 30% of our demand or 40% or whatever, it's material. And it rights a wrong that has been a problem for a really long time. Like we have one of the largest boron mines in the world, which boron is also needed to make rare earth magnets. It's in unsurprisingly named Boron, California, which is just a few miles away from the Mountain Pass mine that MP used to do. This is how we used to make magnets. We had those two mines. Boron's owned by Rio Tinto, and that supply, just made us go for a really long time. And then, the economics of Mountain Pass kind of started to fail. Molycorp famously went bankrupt. MP has resurrected it. But like this is we're coming into this period where prices have gotten to the point that'll support the Mountain Pass mine. It might support some of these other sort of characteristics, and we'll probably make it happen. For better or for worse.
Well, I think it goes back to what you were saying about you need like a crisis point, or like you get to a certain point where it's like really an issue, and then we're going to throw everything we have at it as fast as possible. Yep. So I think that'll show up in other commodities in certain sectors, but you definitely are starting to see it specifically in rare earths with what's going on with China right now. But
yeah, exactly. And titanium as well. Like if you're not familiar with IPX, I'd suggest checking it out, because that facility is ramping up to commercial production here this year. There is a massive, like we can take care of a significant portion of our own aerospace titanium demand just by that facility itself, which is also it's zero carbon emissions because they're reducing the titanium with hydrogen, which the U.S. does have a pretty decent supply of. Whether that's blue hydrogen coming from natural gas steam reformation or other sources as well. They're going to do it. And although the management I think has had some past failures in the market, this one I think has legs and is going to go for a really long time. Honestly, it could 5x from here, and it's already doubled since I picked it up during Liberation Day period.
Interesting. I'll have to take a closer look at that. But I'm sure what everyone is hoping to hear about is some of the actual coal names. But yeah, I had to detour into some of the stuff that I think is really interesting with all the different events going on. But
yeah, it's all right. I mean, copper kind of falls into that policy driven thing too. We talked about it a little bit beforehand, but the differentiation between like the U.S. market and copper is completely policy driven relative to like copper in China or elsewhere in the world, or the LME. And just wanted to say before we move on to the coal names that having done a modicum of work with folks who engage the U.S. Trade Representative's office over fees on Chinese vessel use, which would have decimated the coal industry and really hurt farmers as well. Because it's about, I think Chinese-owned vessels comprise close to 50% of the global dry bulk fleet. The National Mining Association did a great job and eventually, convinced the Trade Representative's office to table that idea or eliminate it completely. So they'll revisit it in a year or so. I suspect on copper, it's going to take a few weeks or maybe a month or so, but I suspect that's what's going to happen as well, because the policy itself, like, putting the export ban on, concentrate or on cathode or whatever, it just doesn't work. It's not smart. So certainly all the miners are going to speak up about it. And knowing what I know happened with coal on the USTR side, I'm cautiously optimistic that they'll fix that at some point in time. But in the meantime, it's going to be pretty weird and volatile. So just caveat emptor, but I still think longer term copper has legs.
Yeah, I think it's an interesting sector to be looking at. I just haven't found any like copper miners or any specific companies where I get really excited about that. I think
Mhm.
the obvious one that's probably the 800-pound gorilla and has some coal exposure is Glencore. So maybe we could start with that one and kind of see where
Yeah.
that takes us. But
Yeah. So let's do that. Let me share screens, and for Glencore, um, let me just go back to let me start with the thermal coal slide, so you can see the correlation between TTF on the red line and API2 Rotterdam on the black line. Um, so as goes natural gas, which as we can see is kind of troughing. So goes thermal coal. So thermal coal is still cheaper to use. So when we get into those names, which would include Glencore, they have a huge operation in Colombia. And this is where they deliver into. This number is probably coming down in the short term, but it's summer, so eventually it'll certainly go back up. So let me eliminate that, and let's go into well, what do you want to look at first?
we can start with the big dog, AMR.
All right, so let's look at Alpha. So Alpha had this move from 100 to 140 bucks, 40% move just in a month. Largely, this was a factor-driven rally, and by factor-driven rally, I mean it was two things have happened over the past month or so. Stocks that are small caps and stocks that have very high short interest have just rocketed up. So, there wasn't really any change in fundamentals at all. It was more of a, like I said, more of a, kind of a.
Well, you've got stuff like coal's going up like what 80% or 100% in the day. Like moves like that just make no sense. So
Yeah. And so let me pull up. All right. I'm going to pull up my Thinkorswim here. Can you see that?
Yep.
All right. So, here's AMR's chart. I've got two things here. The green band here, this is the, green versus red. This is the volatility of the equity itself. And then this green and red lines here are the volatility of the options chain. All right. So I try to use them in conjunction with one another, but let's zoom in on the past couple of months so that we can see what happened. So my program, generally when it dips, these are two standard deviation moves. When it dips below the equity volatility, my program is going to throw off a buy signal. And then when it goes above the top part of the equity volatility, I'm going to set a trailing stop. And so this last move from the 14th up to when did it peak? What day is that? The 22nd. I didn't catch that because we didn't get all the way back down to the bottom. I'm a mean reversion trader, so that's kind of what I look for. But when you look at the options, look how close we got down here to the bottom, and we did not get up to the top. And then when we move into the next month, the implied vol just raised the entire range of the price of the equity. And so, I was looking at this, but when the stock gets back down here onto the median level of vol, it's hard to determine which direction it's going to go. While I was pretty confident that we were going to move in the other direction at this point, what I don't know is where we're going to wind up at the bottom. I would venture to guess, Alpha's production last quarter looked pretty good. I know that they have a program that they're managing their costs. They have the best damn met coal salesman on the planet in Dan Horn. So to the extent that they can maximize their realized prices, they're certainly going to. We're also heading into domestic negotiations. I wrote a piece on that yesterday. That's available at the Coal Trader Substack or at thecoaltrader.com. I, unlike many other people, think domestic prices are going to go up this year because the steelmakers can afford it. But I'm in the minority there. Canadian steelmakers cannot. but the U.S. with protective tariffs we have the highest steel prices in the world, and every mill is making somewhere between $100 to $300 per short ton margins. And I understand that Cliffs, for instance, has a lot of debt. They have a lot of legacy liabilities. They're watching costs. I just I think this is one of those things where a couple of years ago, Alpha and Ramaco and the other domestic suppliers cut the steelmakers a break because there was a union strike that was going on. Steel prices were in the toilet, and historically, when steelmakers can return the favor at least a little bit, they generally do, and even if begrudgingly so. So, I think in the fall, it's hard for me to be like super bearish on AMR, at 115. But if it gets down into into this 100 level or below 100, it's kind of a no-brainer because they got the balance sheet to withstand this part of the cycle for sure. And they're adding additional low vol tons, which are going to fetch a higher price in the market. So I like it here. It's just one that you have to be really patient with, or alternately, put Bollinger Bands on, put some kind of like Keltner channels, any kind of kind of aid that can frame this price range for you. That's how you have to kind of weather the storm periodically. Like when the price goes down here, move up to your max size, which for me is usually like 5 or 6%, unless I'm purposefully overweighting something. And when it gets up here, take it down to your minimum allocation, which for me is like 1.5 or 2%, and rinse and repeat, and just kind of keep moving forward like that. But that's AMR in a nutshell. What do we want to look at next?
Yeah, I guess the one thing I'll maybe add as a question in for that is, what's your kind of long-term view on AMR? I know you've kind of said in the past that if the coal prices really get moving, AMR is the kind of large cap guy that has the most torque. But
it is by far the torquiest. I mean, and if I zoom out here and take a 5-year view, you can see it. Like look, because they're committed to buybacks, like during this period of time from early 22 until 2023, like the met coal price peaked. I want to say, where's March 22? Here, met coal price peaked here, and went down 40% after that. But what they were able to do is they were able to capture a lot of higher priced domestic sales in 22 that lasted through this year. And when they started to those numbers started to realize, and their buyback was going on, I mean, just look what happened. So that philosophy for them has not changed. When they have money in the bank, they are 100% going to buy back stock. And if, when we get into the next part of the met coal cycle, that same trend is going to wind up happening. And, keep in mind that, I mean, they retired 10% of their stock during that period, probably, or maybe 20, can't remember exactly how much, but they're going to have a chance to do that again. And they'll be able to do it, maybe while the stock is still down around $100. So yeah, it's super torquey. And that's because their board, which is now chaired by Mike Grzinski, who kind of orchestrated this buyback program to begin with, is laser focused on that. So they can't do it right now. They're managing their cash balance. They're bringing on higher priced production in low vol in the Kingston Wildcat mine, but they're getting ready for this next cycle. So it's a great time to start to accumulate it, but just keep in mind that like it's going to be stuck in this range until met coal prices for real get off the schneid. So caveat on that, we're wearing the Alpha jersey today. Love those guys, still do, and like the next cycle is going to look maybe not quite as exaggerated as that one, but there's no reason why they can't triple in price during an upcycle.
Yes, that maybe brings me to the one that people aren't as sure that there's going to be buybacks, but they do have a big project coming online. That's Warrior Met Coal. And that's one that I find very interesting at current prices. But if we do get like another dip in the next, call it 6 months, but really into the back half of this year, it sounds like they're the way I view it is anywhere below like 45 is a layup. But like if you're starting to get near 40, like it is just very, very cheap and a very good setup for, okay, you're increasing production in the next 12 months. You're, like you said, probably going to have the start of the next cycle in the 12 months after that. And you kind of have that setup where, okay, 40 is the wrong price. Is it headed to 70, 75, 100? I think eventually, but
so the, here's what it's looked like over the last month. And this is again, the same sort of setup. So, back here in late June, when it got down to 41, like this is really easy territory to pick it up. This is the same price it got down to in like May of 2023, before it went on that absolute tear. I wrote to subscribers, we captured pretty much all this move up to 50. But, obviously we didn't participate in this run up to 60. So the implied vol has obviously shifted up here, in these monthly options. And the downside, I think right now is like 45, 44, somewhere around in there, not necessarily 40. But because they're developing Blue Creek, they have tons coming into the market. The only place they can place them is into Asia. And so they are getting absolutely horrible realizations on their coal price right now, to the point where, I think if they continue down that path, they're going to damage the value of U.S. high vol. So, if Walton Dale are watching this, quit it. But that said, they're going to have to put these Blue Creek tons in the market. They are going to have to probably, put out some of their competitors. But I mean, there are folks who are on the verge right now of bankruptcy on the high vol side, in West Virginia. That's probably going to happen anyway, regardless of what Walton Dale do. I just, my concern is if they continue to project the value proposition of U.S. high vol coal into, the Asian market, which is the only one that's growing, then, they run the risk of permanently damaging the brand, which would limit their upside. But that said, I mean, this is going to be a 5 million ton a year mine. So whether we like it or not, revenue is going to go up. So, revenue inflects upward. I'd like to see margins inflect upward, but that's dependent upon sales. So that's what we have to realize. I don't think this report is going to be very particularly good, and Walton Dale are always pretty bearish. I mean, they're one of the most bearish companies on calls in the entire industry. And so, they're not doing themselves any favor on the stock options. So I think, if not post call, certainly in the fall when restocking season ends, we're going to get a chance to buy it down in this region again, in the 45s, maybe down to the 40s. And like we said before, like that's it's a no-brainer there. I think ultimately, if they price the high vol like they should and sell it to the right people, I think this is $120 stock in 3 years.
Yeah, I think it's one of the most interesting risk reward too, because you have, like you said, the increasing production. I think a pretty relatively limited downside. But maybe that's one of the things I have a question on, and this is a little bit of a sidetrack from kind of stock specific stuff, is the impact of tariffs and kind of the tariff on, tariff off action that we've been getting. Is that something that hits the U.S. Production? Like, because I know the steel tariffs and some of the other stuff has an impact on the oil and gas industry and their costs. But what does it do for some of these coal players?
Well, I mean, it's not great, right? China already has implemented tariffs on U.S. coal, which has caused at least one of the trading houses to lay off a bunch of people. If you're exposed to China and you're a U.S. producer, you got problems. If you're exposed to Ukraine and you're a U.S. producer, you've had problems already. So, it's not helpful. But also we can't predict it. It's a fool's errand to try to predict geopolitical anything. And it's certainly a fool's errand to try and predict what trade policy is going to be under this administration. It's governed by true social posts. We're not in an era where we're really thinking about stuff. It's ready, fire, aim, and then you have to hope that the counterparty comes to the table in a way that is constructive for the industry that you're looking at. It's a problem, but I don't think there's a ready answer for it. I think it's just one of those things where when it happens, we react, and that's the best we can do. Wish I had a better answer for you.
Yeah, I know it. I've started to tune out the tariff headlines and some of the stuff that you see on social media, because it's just like, what am I supposed to do with, tariffs on this country going to 15%? That you see next week it's 25, and that's back to 0. It's just like, I'm not going to trade on that. So like, I just basically tuned it out. So
I'm forced to pay attention to it because, it all matters, on the forecasting side, but I wish I could tune it out because it's not helpful. Just makes everything much more difficult to try to figure out. And I can tell you firsthand that the producers are weary of it already too. So it doesn't just affect the other countries. It affects our own ability to do our jobs. So
as far as the other major player in the U.S., that's the Consol and Arch merger into Core Natural Resources. I think that would be one that would be interesting to take a look at, because I think I wouldn't be surprised if we see more consolidation moving forward for kind of the whole sector. But apart from Peabody, this is kind of the other major name that people will look at and say it's liquid enough to trade, really. But
this one is the safest. For two reasons. First off, the Consol piece is all domestic, and it sells into PJM, and the PJM Power Region auction that just happened was bananas. I mean, all-time high prices, and the Consol piece of Core has PJM power price linked contracts. So when the PJM power price goes up, these guys are going to rake in the money. That complex alone, just the Pennsylvania mining complex, is going to generate about $400 million worth of free cash flow every year that they can use to buy back stock. So I look at the Arch piece of it, on the Met side in particular, it's just a call option on Met. So if Met prices go up, I mean, this company's going to make money hand over fist, regardless of what we do. But again, here, this has been my ride or die. This is a huge position for me. I'm overweight on it, less so when it got up to $83. I took it back down to kind of not quite the minimum, but higher than 1.5 or 2%. And I'm starting to buy it back here now. Back here at 60. Is that what the low was? Let me zoom out. And sorry, my apparently I'm drawing. There we go. Back in April, I remember being in West Virginia for my band had a reunion concert, and I remember writing on their report when it went down to like $60. I was like, "This is stupid. That is an absolutely stupid level for it to get down to." The amount of cash flow just that the Pennsylvania mining complex makes more than justifies that price right there. So to me, that's the cutoff. It's kind of been range bound for the most time since. Obviously, it ran up with the whole group. Yeah, with the high short interest stocks as well. But you shouldn't be shorting this one. This one's going to be a beast. They're going to generate a lot of cash flow. The range is very well sort of set, and they're going to buy back stock. They are buying back stock. So when met coal gets going, this one's going to go. I mean, it's going to at least double. And with the buyback, I mean, it could do more than that, I think, during a really positive met coal cycle. So certainly anywhere below 70, it's easy buy.
So it's maybe not as prone to pull back in the back half of this year with the buybacks like you're saying,
Yeah.
but
Yeah. And while I'm here, one of my other larger positions is Alliance Resource Limited Partners. Thermal only, U.S. domestic focused, but again here, I mean this was a pretty easy buy down here at 25. It touched on it when they reported the other day. Briefly got down to 25.50, and anything below 26 down to like 20. Anything between 24 and 26 is a great buy. Power prices again are going to continue to go up, and that actually kind of brings me to we might as well look at Peabody while we're here too. Peabody's U.S. component is going to make money, both the PRB and the U.S. Thermal coal operations. So Australia is going to be a bit of a slug for them, and again, they're very dependent on whether or not this deal goes through. Their valuation is wholly and completely dependent upon it. But they're not going to lose money, until we see what the outcome of this deal is. But to frame it,
kind of guess on timeline for that.
I mean, August 19th, I think, is the initial cutoff date. Okay. I would suspect that they're going to get a 3-month extension, and Anglo is going to try to make the deal more palatable to them. So I expect the deal to go through. I think there'll be some reasonable concessions on either side, and if it does go through, I think we kind of go back and explore these levels, because they'll have a lot of debt. That'll be difficult to service in the near term years. I mean, they lost money on met this quarter, and if they take on more met, the cost for those mines. I don't think those mines are making money either with, if you include maintenance CapEx. So, met's going to be a struggle for them until the cycle gets really going. So, but by the same token, I think the U.S.'s value alone is worth picking up down here in this kind of $12, $11, $10 range. And you've seen it can get as high as 17, $18. And if the deal does get nixed, I mean, I think we go back to like 25, because that just eliminates all the capital risk for them.
Yeah. I think that may be an interesting segue into the Australia, because they do have some Australian operations. But if you may get into those briefly, I know that you're a fan of Yancoal and a couple other names there, but I just have questions on like the long term. Like you see some of the government policies coming out of Australia, and it is interesting, I guess is an understatement. But as far as like the royalties and how like that industry could get hosed, like I just have questions on if that works out really well for a lot of those operators,
At these prices, it really doesn't matter too much. The royalty regime, if met coal stays in between 150 and $200, is kind of similar to what it used to be. So not really an issue right now. The issue is when it gets up to like $500. That's when like the U.S. is going to drastically outperform, the Australians. Now, will that royalty regime be removed and they go back to the old ways? I don't know. You're asking the wrong guy. Me commenting on Australian politics is pretty pointless. But But one thing I can say without beyond a shadow of a doubt is that Yancoal is a badass. This is the 5-year chart. Let's pull it up on the 1 year. Like anything below $5, this is easy money. The dividend's great. They're going to make money consistently. They might do M&A or something like that, which might drag them down. But anytime they go this direction, it's just the easiest pickup known to man. And of course, if you live in Australia, you can take advantage of the franking credits and stuff like that. Like it's super easy. And while I'm at it, I might as well just pull up Whitehaven. I mean, all of these coals, all these companies in general. I mean, let's actually just look at them. Here's Yal. Where is it? There. Yal. Oh, sorry. Terrible typer. Yal. New price scale. And let's do Stanmore as well. So like of the three, Stanmore is the one that's been lagging, kind of in value, but they've all taken the same path, right? And just out of curiosity, let me see if it has tracked. Yeah, it's basically like Whitehaven is basically tracked Sheffy rebar. Yancoal is kind of mirrored Whitehaven. Stanmore is kind of mirrored Whitehaven. So like they're all kind of doing the same things. So if you track Chinese steel, all three of those stocks, and I'm going to throw up New Hope too, just out of curiosity. What is it? NHC. There we go. And take a look at it. Yeah, it's the same. It's the same pattern. Like it's so. I think it's safe to say that when it comes to Australia, coal is just going to move together, for the time being, for better or for worse. And, all of those stocks similar to the U.S. ones, and I don't, Thinkorswim is notoriously U.S. centric. So, I could pull up the pink slip numbers for those, but because the volatility is a little bit different when stocks are liquid, it's never quite as accurate as if you look at it on TradingView. But I think the cycle's still intact, right? We're going to have thermal coal restocking, met coal restocking through, call it September, October, something like that, and then the bottom's going to fall out of the market October and November, like it always does. And that's I think the point where we'll revisit some of these lows, and it'll be easy for folks to get back in. So like if whether you're trading or whether you're doing long-term investing, I think you can, stocks like Core, you can accumulate. We didn't talk about Natural Resource Partners either. Natural Resource Partners is another MLP royalty company. They just collect checks. That's one that you can accumulate. I think you can accumulate Yancoal. I think you can probably accumulate Warrior, certainly below $50. You can probably start to accumulate AMR. But like, we're not in a hurry, I think is the bottom line. There's not anything that's on the horizon that's a catalyst that's going to be like, massive upside in, because of X, Y, or Z. If we do get another big rally, it's going to be factor driven, just like the last one was. It's not going to be driven by coal prices, I don't think. I think everything's kind of range bound. It's very tradable, and more importantly, like I think it's better for people to just understand that cyclicals do cyclical things, and we're getting ready to start another cycle. Within the next year and a half. Just keep paying attention. Stick them on your watch list. Watch them when they get down to levels. Whether you're using Bollinger Bands or Keltner channels or whatever. that look attractive, you can play around with it. But yeah, do we need to size up today? Nah, I don't think so. Not yet.
Yeah, well, I think the high level picture for a lot of these things is, I mean, pick your commodity. Basically, the demand is continuing to hit all-time highs every year, where it's like coal, oil. I mean, you name it. Like, we're using more of it year after year after year. So I think eventually that comes into play for a lot of these things. In the next, I think, couple of years, the coal sector will start to get moving. But I don't know if I kind of skimmed over anything, but if you want to slide any last thoughts in, I think this would be a good place to do it.
I mean, the dollar is kind of the other thing that's on my mind, and interest rates, right? Because when if the dollar isn't going to perform, then commodities are going to do exceptionally well, because that's you're trading fiat for physical stuff, and that's something that I think is kind of important to point out. Like the only situation in which commodities don't do well is like a real deflationary event, synchronized global recession, something like that. That, and let's be fair, like that's going to be a possibility in 2026. Certainly, if we keep up the antagonism on the trade policy, there is a chance that the market will, again, will force the hand of the administration to take measures that it doesn't really think it needs to right now. At the end of the day, whether we all like it or not, markets work, and that's the one thing I think for me that makes this job really interesting is like you always learn something just by paying attention. And having worked with policymakers, that they think they know, but if you've been around markets long enough, you know that nobody knows, and that little bit of hubris goes a long way when it happens. And so for me as an analyst, those are the points where that are moderately entertaining. When people sort of realize that, oh, hey, we don't know as much as we think we did. I even like that when it happens to me. It's because when that happens, you get smarter. That's the only way we get smarter.
Yeah.
So I'll leave you with that thought. But in the meantime, anyone who wants to check out the work we do, thecoaltrader.com or thecoaltrader.substack.com. You're more than welcome to follow me on Twitter at mfwarder. Finley is my middle name. It's not it's nothing untoward in that handle at all. But yeah, it's as rough as the last year's been, still incredibly optimistic about, I think, coal's future. I'm really excited for for how everybody's been able to clean up their balance sheets over the last few years. This trough of the cycle has been, I mean, it's as Andy Eidson says from AMR, like it's not fun, but it's familiar. I would add that this trough has been way more fun than previous troughs.
Yeah.
If the bottom is 160 or 170, like we can handle that for a little bit. That's okay. If we get down to like $100, on the medical side, we're going to worry a lot. But right now, I think the future is still pretty bright, and we'll probably get some policy tailwinds that'll help things out going forward.
Yeah, I guess the one last thing I do have to sneak in while I have you is I have to ask my traditional closing question, which is, what book should I add to the reading list? I think you've given me a couple good ones so far, but got to keep growing the list.
Oh man, the one I just read that floored me was Apple in China. Have you read that one yet?
I actually just got that recommendation last week from Wilson from HFI. So
my God,
2 in a week. So I definitely have to add that. to
Yeah,
and
you got to
maybe
read
move
it.
it to the top. So
Yeah, I mean and the reason being this is relevant to mining, right? Last year we graduated. The United States graduated something like 126 mining engineers, and China graduated hundreds of thousands. So the idea that it also, I think 54% of the U.S. reads at a sixth grade level or below. 25% of the U.S. is functionally illiterate of adults. If we're going to really compete with China, we have to do our homework, for lack of a better turn of phrase. And the amazing thing about that book is the reason that China has gotten to this place is because of Apple. Because Apple went over there for the lower cost of labor, but they found that they had to train people in order to do the jobs that they needed them to do. And it's a little bit ironic that Tim Cook in an interview recently, they talked about if they put out a job offer for tooling engineers in the United States, they'd maybe get 2 applicants. And if they put one out in China, they'd get 2 football fields. Well, guess who engineered that? Apple. So that's why the book is, to me, is really interesting, because it is they are a huge part of why China has leapfrogged us in terms of just general manufacturing ability, general engineering ability, those sorts of things. Things that when Eisenhower instituted the GI Bill in the 1950s, which, by the way, provides free college for anybody who's listening. You can exchange service for college. It's been on the table for a long time, but they did that to encourage more people to get STEM degrees. Engineer. We need more engineers. We need more scientists. We need more people who can do math. And if we're going to keep up with China over the next 20 years, we just have to do our homework. But yeah, that book was an eye opener, man.
Yeah,
and,
I'll definitely have to add to the list. But it does remind me, I have a buddy who's pretty familiar with China, and he always would say, you know what R&D stands for in China? Rip off and duplicate. So
hey, but you got to have people who can do the job.
Yeah, no, but he always would make that joke and
it's
get
a
a
good
couple
joke,
laughs.
and it's 100% relevant.
I mean, you do see some suspiciously designed automobiles as far as looking like German cars and whatnot. But anyway, I'll leave that for another day. But I really appreciate you coming on. I think everyone will get a lot of value on it, not just on the coal stuff, but also the rare earths and other stuff we got into. But I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.